Brad Williams, Frugal Finance. This is very critical for first-time home buyers understanding private mortgage insurance. Private mortgage insurance is a type of mortgage insurance you might be required to pay if you take out a conventional loan with a down payment of less than 20% of the purchase price. PMI protects the lender, not you, if you stop making payments on your loan. The requirements to buy PMI usually also applies to refinancing a conventional loan when your equity is less than 20% of the value of your home. PMI is arranged by the lender and provided by private insurance companies. It insures the lender against loss caused by borrowers failing to make loan payments. Make no mistake, fall behind on your mortgage payments. PMI does not protect you, and you can still lose your home through foreclosure. PMI can help you qualify for a loan that you might not otherwise be able to get, but it can increase the cost substantially. Sure, you're aware it's a big chunk of change. Before agreeing to a mortgage, ask lenders what PMI choices they offer. The most common way to pay for PMI is a monthly premium. The premium is shown on your loan estimate and closing documents on page 1 in the projected payment section. The premium is added to your mortgage payment. Sometimes you pay for PMI with a one-time upfront premium paid at closing. The premium is shown on your loan estimate and closing disclosures on page 2 in section B. If you make an upfront payment and then move or refinance, you might not be entitled to a refund on the premium. These upfront premiums are no good. Sometimes you pay with both upfront and monthly premiums. The upfront premium is shown on your loan estimate and closing disclosure on page 2 in section B. The monthly premium added to your monthly mortgage payment is shown on your loan estimate and closing disclosures on page 1 in the projected payment section. Lenders might offer you more than one option. Ask the loan officer to help you calculate total cost over a few different time frames that are realistic for you. How does PMI compare to other parts of my loan offer? Ask lenders to show you detailed pricing for different options so you can compare and decide what option is the best deal for you. Interest rate. Lenders sometimes offer conventional loans with smaller down payments that do not require PMI. As a trade-off, you usually pay a higher interest rate for these loans. Paying a higher interest rate can be more or less expensive than the PMI depending on a number of factors, including how long you plan to stay in the house. And at what point can you cancel PMI? That's critical. You might want to ask a tax advisor whether paying more in interest or paying PMI might affect your taxes differently. Other loan programs, borrowers making a loan down payment might want to consider other types of loans, such as an FHA loan. Other types of loans may be more or less expensive than a conventional loan with PMI, depending on your credit score, your down payment, the lender, and general market conditions. You might consider saving up the money to make a 20% down payment. When you pay 20% down, PMI is not required with a conventional loan. You can also receive a lower interest rate with a 20% down payment. Comment: if you're concerned you don't understand what PMI, you're going to have PMI on conventional loans. If it's FHA, you're going to have a mortgage insurance premium. There's still a chunk of change either way. With FHA, you're going to pay it up front. On conventional, you can pay it monthly. I wouldn't go any other route except for on a monthly basis. Comment: if you have any questions, concerns related to private mortgage insurance, let me know. Brad Williams, Frugal Finance. Hope that helped. Thanks for watching. See you soon.